Hello and welcome everybody to this XTB video. My name is Walid Koudmani and I'm the XTB Market Analyst. And in this video we're going to cover a very important topic, which is the US dollar, which some of you may know as the world's reserve currency. That's the way it's considered. And we're going to ask ourselves a question, which is the US dollar headed for a fall? As many of you may know, that demand has been increasing over the pandemic, and we are going to take a look at a number of factors that affect the dollar, some of the history, and some of the other markets correlated with it, like commodities and other currencies and indices. So some top news for the week starting the 24th of August. We had US 500 index, so the S&P hitting all-time highs. US 100, so NASDAQ surges higher thanks to Apple and Tesla. Dollar recovers on stronger US data. On the fundamental level, Trump narrows the gap to Biden in polls, which had been widening up to a 14-point gap, which has now narrowed down in some polls to around 4. Auckland, New Zealand extends COVID restrictions. New Zealand, some of you may know, that was one of the countries that handled it the best. And because of that, now everybody's keeping an eye on the way they react to any sort of increase in cases of COVID. Commodities. Oil, gold, and silver slightly down on stronger USD. So we've seen them, the prices consolidate and pull down from the highs that we had seen prior. This week there's the Jackson Hole Symposium, so the meeting that they have, the key market event is this week. And so we're going to cover the US dollar. Is it headed for a fall? What are the factors that affect the dollar? And what are the markets that are correlated to it? So, enormous US deficit and unprecedented Fed's policy raise questions about the US dollar's role as the reserve currency. Some people may be losing confidence in it. Is the US dollar headed for a fall? Can it be replaced? That's one of the key issues. And what does it mean for the dollar's strength? What are the consequences for other asset classes? And will current policy result in high inflation, which is an increased cost of living? Record pace of money printing pose threat about the US dollar's role in global economy, because of the fact that obviously the more printed it is, the lower the value becomes as of supply and demand. Does it mean that American currency is set to lose its value? And these are the things that we're going to cover in this video. So the US dollar-based system, this is some history regarding the dollar. The USA increased their gold reserves during World War II, and then gold became convertible to the US dollar until 1971. For this reason, the US dollar became the reserve currency. Nowadays, it has over 60% share. What does a reserve currency mean? It just means that central banks across the world carry the US dollar as reserve. USA could maintain deficit without fear that the dollar would lose all its value. However, over 40% of the global debt is denominated in dollars. Most commodities are also being priced in dollars. Some key examples would be oil and gold are priced in dollars. However, the US plays key role in cross-border payments system, SWIFT, so when bank transfers from one bank to another. Therefore, the Fed might still export its monetary policy by increasing its balance sheet. The Federal Reserve is forcing other central banks to apply the same policy, otherwise their currencies would strengthen against the US dollar. And since some key commodities are traded in US dollars, if you're trying to trade against a stronger US dollar or a weaker US dollar, then that is the balance at play here. Nobody wants that during this tough period, and other countries, for instance China, would need to create a new system around its own currencies if that were the case. So we can see that the deficit is as high as during World War II, which obviously increased spending massively because of all the world war that was happening and demanding resources and all of the military equipment that was needed at the time. Governments responded with huge stimulus to coronavirus because of the related restrictions. The first stimulus package in the US was worth $3 trillion, which is around 14% of US GDP. Americans want to spend even more, so the next stimulus had been expected to be worth $1 trillion, but the deal was not reached because Democrats wanted another $3 trillion. That would be terrifying debt increase. However, it is important to note that because these demands are very high, because we had seen up to over 50 million new unemployment claims over that period of time since the beginning of the pandemic. So obviously these stimulus packages would have been going to people that then would have had to reinvest into the economy. Is there any hard limit for the level of debt? In theory, let's say, Japan proves that there is really not. Their debt exceeds 250% of their own GDP. And there's only one condition. The debt must be financed internally. So the Bank of Japan has been financing the majority of the government's needs. Soon it's going to hold 50% of the country's debt. As you can see in this chart here, the total holders of Japanese debt. 44.2% is the Bank of Japan. Some insurance, some other banks, public pensions, pension funds, foreigners, households, and others. The only positive incentive came from the weakening yen, export-oriented economy. But if everybody does so, the effect does not appear. Because everybody's doing it, so it evens out in a way. And Japan is proof that current policy is a dead end in a way because they have so much debt. And you can see here the percent. Central banks are doing their best. Should such a deficit be financed through financial markets, it would lead to higher interest rates, which would hurt the economy, let alone stock markets. Therefore, deficits are being financed directly through central banks. As one can see, the United States are not an exception in terms of the scale, but it may change after the next enormous stimulus package. Is that the magic money, though, just as Jerome Powell seems to suggest? So just printing money as much as possible? You can see the bank's balance sheets percent of GDP. And the Bank of Japan obviously skyrocketing. We can see the Federal Reserve is the blue line, the Bank of England is the gray line, and the European Central Bank has been making quite the effort. Who pays for the Fed's policy? And this is a key issue. While the Fed is increasing its debt holdings, others, such as mutual funds, pensions funds, and foreign investors, are lowering their contribution in the US debt structure. In fact, they are paying negative real interest rates. If printed money is spent directly, it should lead to higher inflation. At least in 2009 to 2019 period, most of these funds did remain in the financial markets. So we can see that who holds the US Treasury securities, actually. And it's foreign and international investors, state, local governments, monetary authorities, insurance companies, mutual funds, and banking institutions hold about 18%. Individuals hold about 7%, others, and pension funds, as we mentioned. So that whole structure is decreasing now because people are losing confidence in the US as well, which in previous times had been thought to be the most stable economy in a way, because in the long run, the projections were always positive. What does it mean for the US dollar? So under normal circumstances, nobody would like to own such a debt. But current market conditions are abnormal because other central banks have behaved the same way. So they've had to also inject massive amounts of liquidity into the markets. Many institutions are forced to own US treasuries as reserves because they are also increasing their debts. So the US dollar is still overvalued in the long term, but the possibility of another huge stimulus package and political turmoil might be a burden to that. However, there is no challenger. So that's the issue that we tackled in the first few slides, is can it be replaced? So in this case, it doesn't seem that there is, because there is no challenger which could benefit from the rapid plunge of the dollar, because the dollar is what commodities are quoted in and the reserve currency. Taking a look at the dollar, the euro, and the yen, so they're different pairings. The US dollar has lost its interest rates advantage, but is already priced in by the euro. We can see that in these charts. The undervalued yen has more to gain, as the Bank of Japan seems to be out of ammunition. Yields were already low, and with every increasing stimulus, they seem to lose more of their leverage. We can see here the chart that shows us the disparity between the 10-year bond or yield spread and the Euro-USD pair, and how they're now combining. Here they're separating, and here they're separating with the yen. So what are the consequences for other assets? As I mentioned at the beginning, we're going to tackle some other assets and commodities and indices that are affected by the dollar or obviously correlated to it in some way or another. As there is no alternative currency for the US dollar and money printing does not increase its real value, investors flee towards the real value, which are equities and precious metals. There is downside though. Equities have inflation and downturn, so stagflation, while gold has inflation and recovery. Higher inflation might burst the financial assets bubble because it becomes more and more expensive while it's just because the actual money is losing value rather than the assets itself increasing in value because they're quoted in that currency. So summing up, the US dollar is overvalued. Only the premium-related liquidity shortage has disappeared. The Fed is using expansionary monetary policy, but its scale does not go beyond other central banks' policies. So expansionary, they're just injecting cash into the markets to try and prop up both the stock markets and also the consumer market that has been struggling with all the fundamental factors like businesses closing, the lockdowns, and so on and so forth. Those who try to save pay for printing money advantages, but in the case of higher inflation, those who earn less. The reserve status is highly unlikely to change because there is no clear challenger. The yen with chances to gain, the euro without fundamental potential because of the yen structure that we mentioned earlier. And investors are fleeing towards real assets, so away from bonds and all of that, into stocks and precious metals or other, say, safe havens. Higher inflation is the biggest threat for the bull market, both equities and gold, so that is the devaluing of the actual currency. Crypto, seen as a competition, however, still cryptocurrency's role is marginal. Governments and banks will do everything to preserve the status quo, and I believe that obviously a lot of people are still skeptical when it comes to cryptos because there is no fundamental backing to them. However, stocks, is there any upper limit for big tech? So some of you may have been following, obviously, the big news in tech with Apple, Tesla increasing in value exponentially, especially over the last year, but even over the last few months. Apple's market value exceeded $2 trillion, which is only a few years after it exceeded $1 trillion. And Apple might have signaled iPhone 12 premiere date while testing YouTube connection. So it could be potentially on September 10th. This date seems probable looking at previous events because the iPhone 11 was announced on September 10th, iPhone 10 September 12, iPhone 7 September 7, and iPhone 6 September 9. The company announced earlier this year that iPhone 12 will be available several weeks later than usual. This is probably due with some sort of supply issues or corona-related issue. At the same time, the price to sales ratio is 50% higher than previous record levels. We can see that here. Tesla share price smashed through $2,000 barrier. So Tesla shares were around $200, $250, $300 about a year ago, and then the price continued to increase. After breaking through 1,000, we saw this price skyrocket, and the price managed to break through the $2,000 level just most recently. Analyst price targets are chasing the markets. Between quotes, this means that the market is acting faster than the analyst expectations. So they would put an expectation target, the market immediately or very soon thereafter exceeds it, so they have to update or upgrade their targets based on what the market is actually doing rather than the other way around. Only 16% of analysts, though, surveyed by Bloomberg recommend buying Tesla stocks. And the median price target in 12-month perspective amounts to about $1,200, so $1,200, and we're at about $2,000. And this is based on a lot of fundamental data backing these estimates. So the market value, the capitalization, their production, their sales figures, and all of that goes into this account. When we talk about commodities, which again are related to the dollar, which we just started with, gold is cheap compared to overvalued equities. Looking at the gold prices and S&P 500 ratio, one can notice that equities are expensive while gold remains relatively cheap. So this ties into the recovery of equities rather compared to the recovery of the consumer market, which has been more and more different and diverse from each other. So equities are recovering at a faster pace while the consumer market was recovering at a slower pace, so they don't match anymore. Volatility surge, though, 200 session average, and central banks' balance sheets expansion, in fact several times bigger than during the global financial crash of 2007-2008, suggests that long-term price growth might still be ahead of us. So the volatility surge is something that is also looked at frequently, and you can see that it surges obviously in times of uncertainty more than in times of stability. And comparing the two surges between the two different events, we suggest that, or it suggests that long-term price growth might still be ahead of us for gold. On the other hand, one might ask whether such low ratio results from highly overvalued stocks, and this is something that we covered in other videos, is how representative is the stock market and stocks prices of the actual underlying asset. So is one share of Tesla worth $2,000 when they produced less cars, for example, than Nissan or Toyota, or they have much smaller market capitalization at the time when they were valued based on that, and now they're not? So gold, how is the demand structure going to look like? That's an interesting perspective, because the demand for gold isn't just for safe haven or for reserves, it's also for actual practical uses. So the next year is supposed to bring recovery in terms of production and jewelry demand, which you might imagine that decreased this year because of all the financial issues and global pandemic issues. Expectations indicate significant demand decrease of the ETFs and strong physical gold demand growth. Models do not recognize the strength of investment ETFs demand, and they are a major part of demand for gold and silver and precious metals in general. This year, ETFs have bought nearly 800 tons of gold. Full year forecast amounts to 900 tons, and we're in August. So if you can see that the forecast was just very close to what we've already done. But then again, the forecast was probably made before the COVID pandemic, and therefore all this demand from ETFs and private individuals and governments wasn't there yet. Any hints signaling investment demand slide could lead to significant correction. In this case, one should monitor bond yields, because they are also correlated to the price of gold as a safe haven asset. And one more thing we're going to cover is oil's rising contango. So the difference between the spot price and the future price is increase the risk of correction. You can see here the oil price compared to the 12-month contango, how it's widening the gap. And in 1 year perspective, the curve is getting steeper. You can see from top to bottom, current curve 1 month ago, 2 months ago. And you can see that it's getting steeper and steeper. So hopefully this video was useful. We covered a lot of topics, but all I think and hope that were related to the US dollar, and it gave you an idea of why this currency is so important, why it's so followed, and why it's important for you as well to keep an eye on the world reserve currency. So thank you very much for watching, and good luck with your trading. My name is Walid Koudmani.